around the liquidity risk. So how do I compute the liquidity risk, for which there is a specific mechanism of computation called liquidity adjusted VAR, LVAR. So it has gone to that level. Normally, while computing the market or credit or operations risk, we were computing the market VAR, credit VAR, etc. But today we also need to look out for computing the risk that is associated with the liquidity. There are various mechanisms to compute this liquidity adjusted VAR. So we will mainly focus on the mechanisms that are used to estimate this liquidity adjusted VAR in this session. So whenever I talk about the liquidity risk, the key thing that comes to my mind is any borrower, or from that perspective any trader not being able to trade the security at the appropriate price. So there might be a quoted bid price or ask price, right? But I may not be able to trade my security at that particular price. It may so happen that the bid price may come down and the ask price may typically go up. So this may result in general, whenever we are having such kind of scenario, the bid prices may generally go down and the ask prices may go up, which is a scenario where the spread between the bid and ask can get more and more wider. That is where we are saying we are exposed more to a liquidity risk. And in case forcibly, see, generally it's the case, right? Let's say I am not able to sell my particular property. It may so happen that I will reduce the price and then only I should be able to sell the property. So there is some kind of cost that is getting into exit out of the position. Or let's say if I want to buy a particular property, I may not be able to buy it because there is no active market that is involved in it. So if there is no active market, I may be forced to buy it. If there is no active market involved for it, probably it will take too much of time for me to buy, or probably I may have to pay slightly much more to really buy it. So there is a mechanism where we are talking about the spread getting more and more wider, high costs in case I have to exit that particular position, and I don't even know at what price that particular transaction gets executed. Yes, I want to sell off my property. There is no active market for it. So I'm not sure at what price I will end up selling up the property. I may compromise on the price, but to what extent? What would be the new price at which I can sell off my property? That is what creates a big liquidity problem. And generally it is more based on the market in which it is operating. The key characteristics of the market. Is there any active trading involved in it? How many traders are typically present? So is it very few traders, or the number of traders is very large? When I am talking about traders being very large in number, there might be a possibility of very active trading market. And when there is an active trading market, the scope for liquidity risk is much lesser and liquidity itself will be much higher. So, and we are also talking about the frequency of transactions. Okay, there may be thousands of traders, but how frequently they are trading? Is it on a almost on an intraday basis, or daily basis, or weekly, or what is the frequency at which they are getting into buy sell transactions, and what is the size of the trade? Are large volumes getting exchanged quite frequently? The more and more larger volumes at more and more higher frequencies means there is a lot of liquidity existing. So the scope for liquidity risk will be much lesser. So that itself again will boil down to how much time it is taking to execute a trade. Is it very quick, or from the time I get into a buy order for the entire settlement to happen, probably is it taking a few months itself? So the larger the time it is taking to execute the transaction, the higher is the liquidity risk that is associated with it. And what are the intermediate transaction costs, the brokerage fees or any other transaction costs and taxes that are involved in the process. So if the taxes and all are very high, probably the liquidity may not be so high, which will cause liquidity risk. Whereas if the taxes and transaction costs are very much negligible, people get into active buying and selling of the securities even for small marginal profits also. So which means the liquidity will be high in those kind of situations. And there could be some kind of risk. So understanding is required with respect to what is the risk that is involved with an incomplete transaction. And even the standardization of an asset influences the liquidity. Probably look at futures versus forwards. The scope for exiting out of a forward position is much more difficult compared to exiting out of a futures position, because in a futures position offsetting is quite simpler and I can exit out of my position quite comfortably. One, because the asset is more or less standardized, whatever is trading on the exchange, there are numerous buyers and sellers associated with it. So even if I exit out of a buyer position, someone else will enter into a buyer position, which means because of the active market that is involved for the futures, the liquidity risk is much lesser for the futures market compared to a forward market. Finding a counterparty and exiting out of the position is quite difficult when we talk about a forward contract. Similarly, the mechanism where it is traded also, like exchange traded contracts generally have high liquidity and hence low liquidity risk, whereas over the counter kind of transactions, they definitely have higher liquidity risks. So these are some of the things that we need to understand when we talk about the liquidity and factors that are impacting the liquidity and leading to liquidity risk. Then the next thing we need to talk about is the role of bid ask spread. This is a big measure of liquidity and the liquidity risk. We also call it as the cost that is involved with respect to the liquidity of the transaction. The higher the liquidity is, so liquidity, we need to differentiate between these two words. If the liquidity is higher, liquidity risk is lower. Liquidity risk is lower, the bid ask spread will be lower. A straightforward relationship means the liquidity costs are lower. Otherwise, it is the other way. If the liquidity is lower, liquidity risk will be higher, the spread will be wider, means your liquidity costs associated with the trade also will be higher. Now, from an analyst dimension, even these kind of changes need to be included as a part of the financial model or the risk model that is getting created. Because the higher the liquidity risk, the higher will be the cost of trading. So these things also should be determined by the model in quite a good amount of detail. And when we talk about this liquidity risk, we are trying to look at it from the two dimensions. One, we call it as exogenous liquidity. The other is called treated as endogenous. A very interesting aspect of exogenous is whatever is the spread. See, the bid versus the ask, the buy versus the sell, the buy price, so this generally the words, just to give a clarity, the bid and the ask. This buy price, the bid is the price at which the dealer buys. Dealer buy price, dealer sell price are called as bid and ask prices. So from investor's perspective, the bid is the sell price, the ask is the buy price. So what we are saying is, the investor wise, if the asset is more and more illiquid, he may have to sell it at a lower price. But if he has to really buy it, he has to really pay a high premium to buy that. So that is the reason we talk about the bid-ask spread getting widened. Now what we are saying is, if one individual trader, because of the trade that he is placing, see, generally when I do more and more buy orders, the prices may go up. When I do more and more of sell orders, the prices may go down. So even when the prices are going up or prices are going down, that will have an impact on the spread, because if let's say someone has placed a very huge sell order, and because of